We're seeing Russia, China, and other BRICS countries continue to buy gold and silver. Russia and China are also building independent gold markets in moves to bypass the US dollar. And it's something that we just spoke about, right? So these changes have helped actually push gold to historic levels, breaking its 1980 inflation-adjusted high.
But the foreign central banks, people who have to allocate billions of dollars in savings, looked at this and said, this is another nail in the coffin of the U.S. Treasury market. And that's too dramatic a phrase. But this weakens the competitiveness of the U.S. Treasury market. And as we've seen, really, for at least 5 years, it has been disintermediation from U.S. Treasuries into gold that has been responsible for the strength of gold. And that's continuing.
China isn't trying to compete in the gold market anymore, it's trying to own it. Mario Innecco argues that China is no longer just a major gold accumulator, it's becoming the vault of choice for its geopolitical allies. By encouraging central banks from friendly nations to buy and store metal through the Shanghai Gold Exchange, Beijing is directly challenging the historical dominance of Western storage centers like New York, London, and Zurich. This move isn't just about logistics, it's a calculated step toward reshaping global monetary trust and loosening the US dollar's grip on international reserves. Gold's explosive performance in 2025 has only added momentum to this shift. The metal's rise from $2,600 to $3,500, followed by a powerful breakout from a months-long consolidation, has validated both sovereign and institutional buying. BRICS nations aren't just stacking bullion, they're building parallel market structures designed to bypass dollar settlement altogether. Even Wall Street has been forced to acknowledge the trend, with Goldman Sachs calling gold its highest conviction trade ever, targeting $5,000 in the near term. That backdrop makes the growing discussion around an official gold revaluation increasingly relevant. If central banks have been leasing out gold for decades, effectively suppressing prices through hidden short exposure, any attempt to reclaim or revalue those holdings would trigger the mother of all short squeezes. Innecco's suggested revaluation level of $4,222 per ounce, exactly 100 times the old statutory price, may sound symbolic, but symbolism is precisely what monetary resets are built on. If you found this video helpful, don't forget to like, share, and subscribe to stay updated. We'll continue bringing you sharp insights and expert perspectives on gold, silver, and the forces reshaping the financial landscape. Thanks for watching.
But before we do that, I want to look at this challenge in the gold market. And it's an article from Bloomberg. It was earlier this week, September 23rd. And it says, China courts foreign gold reserves to boost global clout. So China aims to become custodian of foreign sovereign gold reserves in a bid to strengthen its standing in the global bullion market, according to people familiar with the matter. Well, I think China understands that he who controls the gold controls the world. And it's akin to what Lord Rothschild supposedly said back in the 19th century: give me control of a country's money and I care not who writes the laws, right? So China is trying to do this on a world scale, and it is a challenge to America and the West. Anyway, let's continue. The People's Bank of China is using the Shanghai Gold Exchange to court central banks in friendly countries to buy bullion and store it within the country's borders, said the people, who spoke on condition of anonymity as the discussions aren't public. The effort has taken place over recent months and has attracted interest from at least one country in Southeast Asia, the people said. The move would enhance Beijing's role in the global financial system, furthering its goals of establishing a world that's less dependent on the dollar and Western centers like the US, the UK, and Switzerland. Countries have been snapping up gold as a hedge against mounting geopolitical risks, creating the opportunity for the PBOC to offer a haven of an asset deemed crucial as a buffer to economic shocks. Gold has been doing very well, of course, in 2025, We traded up from 2,600 at the beginning of the year to 3,500 by around mid-April. Then we had a consolidation for 4 months, and then we broke out of that consolidation like a symmetrical triangle, which is very bullish. And I think one of the triggers was Chairman Jay Powell, Chairman of the Fed, Jay Powell's speech at Jackson Hole. He nodded that they would start cutting rates again, and surely they did in September by 25 basis points. At the same time, we're seeing Russia, China, and other BRICS countries continue to buy gold and silver. Russia and China are also building independent gold markets in moves to bypass the US dollar. And it's something that we just spoke about, right? So these changes have helped actually push gold to historic levels, breaking its 1980 inflation-adjusted high. And Goldman Sachs even named gold its highest conviction trade ever. And they're calling even for $5,000 gold by next year. And the GDX, the world's largest gold mining ETF, is up about 107% so far in 2025, compared to just 13% for the QQQ Tech Index. So with a 79% chance of another rate cut in October and 91% in December, many analysts believe this could mark the first true gold stock bull market in 20 years. It's through a symbolic revaluation of the Treasuries' gold holdings, and there's been a lot of debate about a gold revaluation. Even the Board of Governors of the Federal Reserve System have published an article. They published an article on August 1st by someone named Colin Weiss, and the title was Official Reserve Revaluations, the International Experience. So it's something they're considering. Yes, there's been a lot of people that some of them I've interviewed calling for $20,000 price, $40,000 even. So the last time the United States Treasury or the United States revalued the gold price, the statutory gold price, was back in 1973 from $38 to $42.22. And in 1972, they had revalued as well from 35 to 38. And so it's been at $42.22 ever since. And the gold is supposedly in Fort Knox and also in other depositories like I think Denver Airport and West Point. And there hasn't been an audit, even though the Secretary of the Treasury has said that they audit it every year. But I suspect that all the gold that has flowed into the U.S. since the end of last year, when we've spoken about this quite a lot of it could be the U.S. Treasury buying or taking the gold back. And what does that mean? Well, the speculation from the analysts, and especially people in the gold bug sound money world, is that the Treasury has been leasing out that gold many times over in order to keep the price of gold under control. But now that they're thinking about revaluing, they need to show the gold. So, or they might not, the markets might take their word for it that the gold's there. But if they're like covering their leases of gold, that means it drives the price up because you have to buy back your shorts. And it could be one of the reasons why we are at all-time highs, and we could go even further up. So, and the price that I'm thinking of for the symbolic revaluation, and I'll tell you why I think why I've come up with this term symbolic in a minute, but the price that I've picked is $422.22. That's 100 times the current price. So right now, that gold is valued on the Fed's balance sheet because the Fed holds gold certificates that the Treasury sent to them when the Fed sent the Treasury all the gold that FDR confiscated back in 1933 to the Treasury, right? I think it's because a lot of people were expecting 10, 15, 20, 30, or 40 revaluation. That I think would play right into China's and the BRICS hands, because I think China and Russia have a lot of gold. I spoke about how China has over 30,000. That's speculation, but there's been really good research about that. Yeah, and that would really hammer the dollar, because a much higher gold price means a lot weaker dollar. So 4,222 is not really a massive devaluation of the dollar or a massive revaluation of gold.
Rick Rule emphasized that while gold's long-term path remains firmly upward due to the steady erosion of the US dollar's purchasing power, investors must respect the metal's natural volatility. He warned that in the short term, gold could easily cool off or trade sideways, not because the trend has changed, but because positioning in the currency markets has become overcrowded. What really matters, he noted, is that the current rally isn't being driven by retail enthusiasm but by foreign central banks reallocating reserves away from US Treasuries. That institutional rotation is far more consequential than short-term investor sentiment. He also reminded that gold bull markets follow a familiar script: the metal leads, then the strongest mining stocks respond, followed by the rest of the sector. That pattern is now underway, making this an ideal moment for momentum-oriented investors to get positioned. While gold ETFs are rising, he clarified that it's price appreciation doing the work, not yet a wave of new capital. Even modest reallocation into gold from broader portfolios could have an outsized impact. A hypothetical rise from 0.5% to 20% portfolio allocation may sound extreme, but mathematically it would equate to a 40x surge in capital flows, unlikely but not unthinkable in an era where holding depreciating bonds guarantees losses. Let's get back to the interview.
Gold historically is extremely volatile. I think that the underlying trend in gold is up, because I believe that the underlying trend in the purchasing power of the US dollar is down. But we've come very far, very fast. People who can't tolerate volatility need to consider taking some profits. I have no problem with volatility. I love volatility. I've been a beneficiary of it and a victim of it for 50 years, so it comes with the territory. If you ask me where we are in the gold bull market, really, I think we're very early on. I liken this to the decade of the 1970s. As we've discussed in earlier interviews, Danny, I believe it's likely that the US dollar loses ultimately 50 to 75% of its purchasing power in the next 10 years. Not relative to other currencies, but absolutely. The consequence of that is that I think gold trades higher. The shot that we've seen very recently, I think, is an advanced market indicator of the fact that investors and savers worldwide are very concerned about the impact of an interest rate reduction in the US. A widely telegraphed trade, and gold moved anyway. As the market digests that news, it wouldn't surprise me at all, given the near-term overcrowded nature of the short dollar trade, to see gold sideways to down. But if you have a 2-year time frame, a 5-year time frame, or a 10-year time frame, I think gold goes much higher. We were talking off the air about the gold equities, which is a different topic, and I guess we can cover them later in this interview. I think the reason is that the primary buyer of physical gold is still foreign central banks. Not your audience, not my audience, not Ma's and Pa's, but foreign central banks. You'll notice that right after the move, right after the news, gold didn't rally because the retail buyer had bought ahead of time. The retail buyer had a look at the impending rate cut and said this would be good for gold. And when gold happened, at least for 2 weeks or so, that buying had been used up. But the foreign central banks, people who have to allocate billions of dollars in savings, looked at this and said, this is another nail in the coffin of the U.S. Treasury market. And that's too dramatic a phrase. But this weakens the competitiveness of the U.S. Treasury market. And as we've seen, really, for at least 5 years, it has been disintermediation from U.S. Treasuries into gold that has been responsible for the strength of gold. And that's continuing. Traditionally, gold bull markets follow a very predictable pattern. The metal moves first. And that was certainly the case this time. In prior interviews, I remember that some of your viewers were expressing frustration. 2022 is an example. The gold price was moving, but the gold stocks weren't. There was then a simple explanation. Foreign central banks were buying gold. They don't buy gold stocks. So a market that had a bid went up and a market that didn't went down. But there's a second reason that's much more traditional. It takes a while for an increase in the gold price to translate into an increase in gold producers' operating margins. We began to see that in 2024, and we saw it expressed in the market in 2025. In a typical gold bull market, it goes like this: gold to the best of the best, the Francos, the Wheatons, the Agnicos, to the best of the rest, the Newmonts, the Barricks, the Kinrosses, to the junior producer, the single asset producer, the developer, the explorer. What's changed this time is that the whole process of the money moving down market has accelerated. Investors who are more momentum oriented and traders definitely want to be in the gold space because now you're in the way of the money. And it's worthy to note that although the gold trade is attractive to you and I, given where we've been, most investors can't spell gold. It is not a crowded trade if the crowd that you're talking about is the generalist investor. The generalist investor, as is evidenced by money flows into gold-oriented and gold equities-oriented ETFs, is still very constrained. The gold equities ETFs are increasing in net asset value because the gold price is going up. In fact, they're experiencing a negative flow of funds. So this is a story that likely has legs, albeit it's a story that's going to be very volatile. Well, to put that in perspective, Danny, the last statistic I have was from JP Morgan Chase. And JP Morgan Chase said that the overall, the global allocation to precious metals and precious metals equities in the US was only 0.5%. Put specifically, 0.5% of the total savings and investment assets in the United States are allocated to precious metals and precious metals equities. Mm-hmm. That's down from a 4-decade mean of 2%. So if the allocation merely reverted to mean, you would have a 4-fold increase in demand. Mm-hmm. I have no idea what a 20% market share, which would be a 40-fold increase in the allocation, would do. I don't think it will occur, to be honest with you. I don't think a 20% allocation, given what I see to be the certainty, the inevitability of a decline in US dollar purchasing power, combined with artificially low interest rates. I don't think in that circumstance that a 20% allocation is out of line. Think about the arithmetic of the competing instrument, which is certainly the US 10-year Treasury. If inflation continues at its current pace, and by the way, inflation should not be measured by the CPI. If inflation maintains its current pace, which I think is closer to 8%, and the interest on the US 10-year Treasury stays at 4.5%, what that means is that gold's competing instrument, the US 10-year Treasury, guarantees that you will lose the delta between inflation and the interest it pays, which is to say 3.5% a year for 10 years. In other words, in the US 10-year Treasury, you're guaranteed by the US government that you will lose between 35 and 40% of your purchasing power over 10 years. That's pretty constructive for gold. So, pardon me, that 20% number is a very interesting number. I don't think it has a hope in hell of occurring, but I wouldn't necessarily discourage it. If you are serious about learning about gold and gold equities, do show up. This is the third, as you suggest, of a 3-part series. The first boot camp, the tapes of which are available for purchase, we covered gold itself and how to own it. Physical gold, why you own it. Gold as a topic. Gold as savings. The second, we covered the best of the best, because in gold bull markets, the momentum has always gone from gold itself to the best of the best to the best of the rest. So we've done gold, and we've done the best of the best gold equities. Those are the first two parts of the series. The third part of the series is where we are in the gold bull market now, when the best of the best have run, when gold is run, and where the money is coming down the rest of the circle. When people come to understand the value proposition and they begin to act on their understanding. The faculty that we're going to have this year for this boot camp is going to be outstanding. In addition to myself, a fairly veteran investor and a fairly veteran educator, we're going to have John Hathaway, who has been a leading gold industry investor for 45 years. Not somebody who failed as an auto analyst. Failed as a supermarket analyst and parachuted down in the gold space where he couldn't do any damage, but rather somebody who's made money for investors through good years and bad. He runs the gold equities business for Sprott, which is a brand name in gold.
Gold's rise is being driven by central banks shifting out of weakening U.S. Treasuries rather than retail speculation. Rate cuts signal currency debasement, making volatility a natural part of a long-term bull market. The usual cycle metal first, major miners next, juniors later is unfolding faster than usual, yet overall investor participation remains tiny. With precious metals still under 1% of portfolios, even a small reallocation toward historical norms could trigger major upside, while traditional bonds now mathematically guarantee real losses. Gold isn't speculative, it's becoming the logical default. If central banks keep accumulating gold while retail investors pile in late, could the resulting supply crunch become so extreme that governments are ultimately forced to officially reprice gold? So, stay tuned for clear, data-driven insights into the financial system. Don't forget to like and subscribe so you never miss our weekly updates. Thank you for your continued support and enjoy the video.